Good afternoon, everyone. My name is Uma Kolempa-Remble. I'm a professor in economics and the head of School of Economics and Finance at Wits University. I will be your moderator for the event this afternoon. We have an exciting afternoon ahead for a discussion on big global shifts and their impact on South Africa. To welcome the esteemed panel and speakers today, I now invite Professor Imran Valodia, the Pro Vice Chancellor, Climate Sustainability and Inequality at Wits University and the Director of Southern Center for Inequality Studies. Over to you, Imran.
Ayhan has dropped him. Could you kindly do the welcome?
Okay, so apologies for that. I understand Prof. Valodia is having difficulty with this connection. So let me do the honors on behalf of Professor Valodia and welcome each of you this afternoon to the exciting discussion ahead. The last 2 years, we have seen the world economy grapple with COVID-19. And just as we seem to have emerged from the pandemic, we have been hit by the Russian invasion of Ukraine. The humanitarian tragedy in the region aside, the full economic consequences of the conflict on the rest of the world is still unfolding. While the fuel price increase can be considered to be a leading indicator of the expected increase in inflation, the food security issues can be considered to be of major concern, especially for Africa. That aside, the long-run shifts in trade systems, the global reserve currency compositions, as well as the possibility of a shift in international financial architecture itself is up for discussion. So this afternoon's discussion, hence, is very pertinent to comprehend these shifts and its implications for South Africa as we navigate these unprecedented times. We have with us today Dr. Francoise Marie-Nelly, the World Bank Country Director for Botswana, Eswatini, Lesotho, Namibia, and South Africa, to lay the context for today's presentation. Since joining World Bank in 1994, Marie-Nelly has held a variety of positions focused on public enterprise restructuring, support to private sector development, regional integration, and management of the oil sector. Marie-Nelly is a certified public accountant and was an advisor to several governments before joining the World Bank. So welcome, Nelly, and thank you so much for making yourself available this afternoon. We're very excited to hear your thoughts. The key presentations this afternoon will be by Dr. Ayhan Kose. Ayhan Kose is the Chief Economist and Director of the Prospers Group of the World Bank. He's a member of Equitable Growth, Finance and Institutions EFI Practice Group. He also leads the World Bank on global macroeconomic outlook, financial flows, and commodities markets. Mr. Kose is a non-resident senior fellow at the Brookings Institution, a research fellow at the Center for Economic Policy Research, a Dean's Fellow at the University of Virginia's Darton School of Business, and a research associate at the Center for Applied Macroeconomics. We are looking forward, Dr. Kose, to hear your presentation. Thank you very much for making yourself available. I would also like to extend my welcome to Dr. Fengler, Dr. Wolfgang Fengler, who is a World Bank lead economist for South Africa. He will be the lead discussant on today's presentation. Also on the panel of presentation discussants are Dr. Kenneth from the School of Economics and Finance, Dr. Ismail Fasanya, senior economist, also from the School of Economics and Finance. Thank you to the panel for making yourself available. Before I invite Dr. Marie-Nelly, I would like to introduce a few of the housekeeping rules. So I'm doing the dual role of now moderating and also having provided the welcome on behalf of Imran. Melodia, if Imran is still online and back in a position to convey your personal welcome, please can you confirm, Imran? Okay. I don't think he is available. Okay,
I am online, Uma.
Do you want to speak a few words of welcome? Okay, apologies. I think the connection is not good enough for Imran to convey his welcome. So the housekeeping rules are as follows. We will have now the presentation by Ayhan Kose, that would be for 30 minutes, prior to which Marie-Nelly will introduce the context. So now over to you, Marie-Nelly.
Thank you very much, Prof. Uma, and good afternoon to everyone, and welcome to this webinar, which is of course organized by the Wits School of Economics and Finance as part of their centenary webinar series 2022. And I really would like to thank you for allowing us to present the finding of this report today. Just by way of introduction and background, as you are aware, the World Bank Group is quite known for its financing. But beyond the financing, one of our strengths is indeed our capacity to bring the global knowledge that we are developing, sharing our analysis and contributing to the policy debate, particularly in upper middle countries such as South Africa. And how do we share this knowledge? We do it in different ways, including through the dissemination of our reports. Today, we are featuring the Global Economic Prospect, GEP as we call it in our jargon at the World Bank, which is a corporate flagship report, which compiles the analysis of our country economies, including from South Africa, into a global forecast. And we provide the World Bank most authoritative economic outlook every 6 months. We usually produce it in January and June of each year, with a particular focus on emerging markets and developing countries. A distinct feature of the JEP is that in addition to global and regional prospects, each edition includes analytical pieces on topical subjects such and challenges facing by our countries. And as you have mentioned, Prof. Uma, the central theme of the editions over the past 2 years, as you can imagine, has been around the COVID-19 pandemic. So if I go quickly through the recent 3 ones, the June 2020 edition came, as you know, after the peak of the pandemic in a number of countries. It analyzed a global economy which was plunged into its worst recession since World War II. And at that time, it was anticipated that the pandemic would have severe and long-lasting socioeconomic impacts that would weaken long growth prospects throughout the world. Then we had the January 2021 edition, which forecast a subdued global economic recovery of about 4% in 2021, observing that the issue of vaccine deployment and investment would be key to sustaining the recovery. And also we observed that government, household, and firms would need probably to embrace a completely changed economic landscape. Then we had the June 21 edition that actually we presented also in South Africa, which forecasted a much stronger global recovery of about 5.6%, but showing unevenness across countries, as many developing countries were still struggling with the pandemic lasting impact, including the issue of being able to access to vaccines, and this was being rolled out. It also featured policy options for reducing trade costs so that trade could again become an engine of growth and also for protecting price stability. So today we are presenting the January 2022 edition, which, as you mentioned, Prof. Uma, comes under turbulent circumstances. In fact, when the World Bank issued its report in January, I think that no one of us could have imagined that only a few weeks later, there would be a full-blown war in Ukraine, between Ukraine and Russia, with deep suffering by the local population. This allows me to remind ourselves that in the past, South Africa has experienced suffering and hardship in history. And we were yesterday reminding of this when we celebrated South Africa Human Rights Day to commemorate those who died at the Sharpeville massacre 62 years ago. So what will be the impact of this crisis, and particularly in South Africa, since we are talking to a South Africa audience today? Even though South Africa trade relations with Russia and also Ukraine are very modest, we estimate that to be about 0.5% of the total trade. The ramification of the record level, the ramification of the ongoing war will also be felt in South Africa in maybe two ways, at least, and Wolfgang will come back to that in greater detail. The first is that oil prices, as you know, are reaching record level, and I believe that every South African now needs to pay about 30% more to fill his tank than a year ago. At the same time, the fact that high commodity prices, are prevailing at the moment, particularly for precious metals, this will probably have a positive impact in South Africa's economy and fiscal position. So obviously, there are the two sides of the coin. So now moving into the presentation of today's report, I'm very proud that our colleague Ayhan Kose, that Prof. Uma you have already introduced, so I will not repeat his title, will lead us through the World Bank latest economic analysis throughout the session. And you will see that the new JEP highlights that global growth in 2022 would decelerate to 3.8% from the 5.6% I mentioned in June. But that was before the war in Ukraine had started, so this had not been factoring in. So I'm curious actually to hear what Ayhan will tell us on that, as most economists are doing various analyses. I think that what will be even more concerning, and this is applicable to South Africa, but other countries in the sub-region that we are covering, is that we will have uneven impact between advanced and emerging economies. One of them was the issue of access to vaccination, where we see significant gap in vaccination rates, although we have a rather significant rate here in South Africa compared with the rest of the continent. But when we compare with advanced countries, we see that advanced countries will all have achieved a full output recovery this year. Of course, again, before considering the impact of the crisis that we see actually unfolding in front of us as we speak. So we will be really pleased to hear Ayhan. And then, as you mentioned, Prof, my colleague Wolfgang will focus a little bit more on the impact on the South Africa and possibly the sub-region economy. So I'm really looking for a very good discussion after the presentation. Thank you very much, Prof. Uma.
Thank you, Marie-Nelly, for laying the context. I would now like to invite Dr. Kose to take over the platform. Please share your presentation. You can take any time up to 30 minutes.
Thank you, Uma, and it's great to join this event. Let me thank Wits University for putting together the event. Of course, Marie-Francoise, Wolfgang, I greatly appreciate you organizing with us and the Wits University. It's great to be with you, even though remotely, and I'm hoping that I will visit the country soon, and I hope that I can visit the Wits University as well. Let me thank Imran, Kenneth, Ismail, and Uma. You are playing the dual role. We really appreciate it. And it's great to have this type of academic power around us, the knowledge of analytical issues and the policy issues. I look forward to the conversation. Now, I'm going to talk about the global economic prospects, largely based on this report we released in January. Obviously, the devastating developments in Ukraine are having far-reaching human and economic impacts. We are saddened by the violence and loss of life as a result of the war, and we stand with the people of Ukraine and the Europe Central Asia region at this critical moment. As you know, the invasion has already caused the largest refugee crisis in Europe since the Second World War. The World Bank Group is taking fast action to support the people of Ukraine. We are mobilizing a significant emergency financing package. We are also working with other countries to support all countries in the Europe Central Asia region that are impacted because of these various channels, which I will discuss today. Now, as the World Bank Group, we are committed to have peaceful international cooperation, which is vital for global macroeconomic and financial stability. We are using all of our financial and technical support tools for a rapid response, working with our development partners to basically mitigate the impact of tragic event. I'm going to show some slides and share some preliminary thoughts we have about the global economic prospects. I'm hoping that you can all see. Wolfgang, you can see the slides?
Yes, very well. Thank you, Ayhan.
Okay, thank you. So where we are in the global economy, growth is slowing, and we have these risks. They are increasing and they are multiplying each other. Marie-Francoise already mentioned we released our report in early January. I invite all of you to check the report, especially the kind of the analytical pieces on commodity cycles, the income or impact of the pandemic on income inequality, and the how to resolve large accumulation of debt in light of the the major debt challenges we have in some countries. We have these analytical pieces in addition to, of course, the global and regional outlooks. I thought that I will structure the presentation today around 3 questions very quickly. And of course, all of these 3 questions now should be considered under this very long shadow of the war in Ukraine. Number 1 question is, what are near-term prospects for the global economy? The second question, what are the main risks confronting emerging market developed economies? And the third one, what are the policy priorities for these economies? Throughout the presentation, I am going to use this acronym EMDEs that stands for Emerging Market and Developing Economies. So before the Russian invasion of Ukraine, our views was that global economy is going through a very steep slowdown. This is a broad-based slowdown, and this is a slowdown that basically is being felt in advanced economies as well as emerging market developing economies. What you see here on the left is the extent of that slowdown. As you see, for the world economy, last year we had very high growth, around 5.5%. We were expecting this year that growth to be around 4%, and the next year around 3%. Now we are going to downgrade those numbers in the coming weeks. In the case of advanced economies, there will be a slowdown. That slowdown is going to be deeper because of the shock associated with the war. Why we have this slowdown? In 2021, there was, of course, exceptional accommodation on the fiscal side, on the policy side. That accommodation is being now withdrawn. And in the case of monetary policy, which we will discuss, the extent of withdrawal is quite sizable. In addition, we had basically very high growth driven by pent-up demand that pushed the kind of the consumption up. In the case of emerging market developing economies, we saw growth last year 6.3%. This year, that number is going to come to close to 4%, and we are also downgrading those numbers as well. Now, one of the important things we need to remember, this is going to be an exceptionally steep slowdown after a global recession. In fact, our calculations suggest global economy is going to go through basically the fastest and deepest slowdown in the post 1960 era. We have seen, we had so far basically 5 global recessions. When you look at these 5 global recessions, on the right, you see how growth basically declines from the first year of the recovery to the third year of the recovery. This, the global recovery is going to basically turn into a very steep slowdown, and that has significant consequences in an environment. Of course, the policy accommodation is being withdrawn, and you have now a major shock associated with the war. When you look at the regions in our January forecast, we saw in many regions growth is going to slow down. For example, in the case of East Asia Pacific, we were expecting China to slow significantly, and to some extent that is materializing. That has, of course, significant implications for other economies, other regions. In the case of Europe, Central Asia, growth we expected going to go down. Now we will see basically outright contraction in that region. There are some regions that can take advantage of increases in commodity prices. If the region is a major commodity exporter, oil, but at the same time, financing conditions are going to be tighter. That has implications for emerging developing economies in terms of having access and borrow at the rates they used to. That environment is rapidly changing. In the case of Sub-Saharan Africa, we thought that growth will stabilize around 3 to 4 band, but of course that growth is not sufficient. With this confidence shock, there are competing effects, and we are working on the numbers to finalize our growth forecast, which we will release our regional updates during the next 3 to 4 weeks. What was basically striking about this global recovery, it was in a sense, the global recovery of 2 different worlds. On the one hand, you had these advanced economies. They put significant policy support. Because of that, they are going back to pre-pandemic trends by 2023, as you can see on the left. In the case of emerging market developing economies, recovery relative to how much output loss we had is weak, and because of that, even by 2023, the GDP is going to be 4% below what we had when we think about the pre-pandemic trend. So the recovery was going to be incomplete before the war. The war is going to have a significant impact on these economies. When you look at investment, you see that again, in the case of investment, advanced economies will go back to pre-pandemic trend investment levels. Emerging market developed economies will see stagnating investment, remaining give and take 4% below what they would have if they did not have of course, the pandemic experience. One of the chapters of the report looks at the impact of the pandemic on inequality and poverty. And in both cases, we think that the pandemic had an impact, and that impact was unfortunately pushing poverty up and pushing inequality up. When you think about what happened during the global financial crisis, and when you think about during the pandemic, the outcomes were quite different. In the case of global financial crisis, emerging developing economies were prepared. They had the policy buffers. That crisis was an advanced economic crisis. So at the end of that global financial crisis, inequality across countries, in fact, has declined. Now, with this pandemic global recession, we basically see inequality across countries increasing. As I already mentioned, the recovery is incomplete and recovery is weaker in emerging developing economies. Of course, there is also this huge inequality when it comes to access to vaccines and what fraction of population has been vaccinated, especially in low-income countries. Still, the numbers are not at the levels we would like to see. And at this rate, we are very worried that even by the end of 2023, vaccination rates are going to be relatively low, that much lower than what they should be. There's also, of course, increase in inequality within countries driven by the pandemic. And the reason is that this pandemic was all about the differences between those they have the means and those they do not have the means, in the sense that we saw significant job losses, we saw significant income losses, especially in lower income segments of the societies, in basically informal sectors, those workers working for informal sectors of the economy, and of course the women and the kids had a huge adverse effects associated with the pandemic. We also know that with the pandemic, with all of these income losses and the basically limited health services, there was an increase for the first time after a generation in extreme poverty at the global level. Now, let me briefly talk about the Russian invasion of Ukraine and its implications for the global economy. There is no question there are multiple channels of spillovers. The war in Ukraine will have global implications, through which the first and the most important channel is commodity markets. These two countries play sizable roles, especially in energy and food consumption, which I'm going to discuss. The second important the channel is the financial market channel. The war is coming on top of the monetary policy withdrawal, the accommodation withdrawal by advanced economies. So the financial conditions are tighter, and given the role of Russia as a kind of the place that generates quite a bit of outward remittances, there will be effect in the neighboring countries associated with the decline in remittances. In the case of trade, obviously, we are expecting larger and more persistent supply chain disruptions, and there will be negative effects through tourism in some countries. The refugee crisis is a big problem, already more than 3 million. I mentioned that this is the largest refugee basically flow since the Second World War. In all likelihood, we will see even larger numbers in coming weeks. Of course, because of the war, there is significant erosion of confidence, and there is a significant increase in uncertainty. When we think about these channels, what is the near-term growth impact? So I mentioned earlier our forecast being around 4% growth this year. We are going to downgrade that number. We are still working on the numbers, but we will have weaker growth. We also know that for the region, Europe and Central Asia, we will see a sharp contraction in activity. For Russia and Ukraine, we are expecting deep recessions. Russia is already struggling, of course, with sanctions and seeing the impact of those sanctions on activity and financial markets. Let me briefly talk about the role of these two economies in the global economy. When you think about the size of these economies, they are quite small. Russia is a small economy. You can think of the kind of the size in terms of the economic size, similar to Canada. And if you look at the kind of the left panel, you see that Russia's share in global GDP, global imports, and global remittances quite small. GDP is around 2%, 1% of imports, and 4% of remittances. When it comes to financial sector, it has negligible, very small global bank claims and FDI stocks. But of course, Russia is overrepresented in some pockets of the global economy, especially in commodity markets and in the eco region. That's where actually we think the war is going to cause significant global economic repercussions. Russia is significant in global energy markets. It accounts for 11% of global crude oil exports, 25% of natural gas exports, and 18% of global coal exports, as you see on the right chart. Russia is also significant in the production of global palladium and nickel. It accounts 1/5 of or more global exports when it comes to these types of metals. Palladium is important because it's used in catalytic converters in car production, and nickel is used in steel production and construction. Both countries are very large agricultural exporters, especially for wheat exports. Russia is the largest exporter of wheat, and Ukraine is the 5th largest in the world. Together, they account for 1/4 of global wheat exports. Ukraine, of course, is big in agricultural markets, especially sunflower oil as well. Now, when you think about these transmission channels, we have already seen the impact of these channels. I'm not going to discuss these in detail. As you can see on the left panel, commodity prices increased significantly with the beginning of the war. There was some normalization, but the prices remain very volatile. You saw what happened to energy prices, the natural gas prices, the nickel markets. So that volatility will be with us for the foreseeable future, given the sanctions and the responses of Russia to these sanctions can generate significant repercussions for these commodity markets. And beyond of course, the markets, we need to worry about food insecurity and basically energy insecurity, which I'm going to discuss very soon. With respect to uncertainty, we have seen a historic increase in geopolitical risk as we are worried about further escalation of this war and spilling over to other countries or becoming much more widespread within Ukraine. And there have been indications of that as well. Market volatility has increased in the United States as well as in Euro area. The other important channel we saw, of course, the number of refugees. As you can see, these numbers really off the charts when you compare with Balkan wars, when you compare with Syrian war. We are going to see much larger refugees. Let me turn to the second question. What are the main risks confronting emerging market developing economies. Before the invasion of Ukraine, we thought that there were multiple downside risks. These risks cloud the outlook, and there is a higher likelihood of hard landing in emerging developing economies. What we meant by hard landing is even a steeper slowdown what we expected in our baseline. Now, with the invasion of Ukraine, we have a much larger menu of risks, and these risks are multiplying. And when you think about some of these risks, they are mutually amplifying. The first risk, of course, is the risk associated with geopolitical tensions. We are going through a period, at least for me, I have never seen in my lifetime the talk about the use of nuclear weapons, and of course, there is significant increase in the defense sector. Spending will be defining characteristics, of course, of coming months and years, with security becoming the #1 issue among major economies of the world. Financial stress was a challenge. We were thinking about it before the war. Now, of course, the challenge magnified with these geopolitical tensions and a stagflationary shock associated with commodity prices, how that basically fuels the inflationary pressures. With those inflationary pressures, central banks in advanced economies have to react and might end up reacting even more aggressive than what financial markets are expecting. That could push the borrowing cost at levels we have not seen for a while, and that could, of course, be a source of financial stress in emerging market developing economies. Supply disruptions in all likelihood will intensify and become more persistent, especially in the case of the commodity markets, the agricultural commodities, and the kind of the transportation and the access to energy. With that, we are expecting significant risks, and some of these risks, of course, are already materializing. You see in the markets associated with energy and food security. When you think about all of these, we already had this major pandemic with us, and we see the outbreaks around the world, and those outbreaks can continue. We might see different variants, and that those, of course, have consequences. Cyber security risks in an environment with a major war in Europe with us. And whenever we have these types of slowdowns and significant inflation and food insecurity, we cannot underestimate the risks associated with social tensions. There were some other risks related to, of course, the climate, very important. And then beyond the near term, we are worried about weaker longer term growth prospects. And with the war, the fragmentation of trade, investment, and financial networks could be a major threat for development in emerging and developing economies. When we think about all of these risks, it's very clear that for the medium term and the long term, we are really uncharted territory. And in that uncharted territory, we might see a much weaker growth outcomes. So let me quickly talk about some of these challenges. In the context of inflation, of course, the inflation was going up before the war. It's going to be now more persistent. In the case of emerging developing economies, we see the highest inflation of the past decade. In the case of advanced economies, we see the highest inflation since the early 1990s. When you look at inflation in emerging developing economies, food inflation has been going up, but now the energy inflation, of course, increased significantly, as you see in the middle panel. With these recent developments, the inflation expectations, at least the short-term inflation expectations, picked up quite significantly, and you see that on the right panel. I mentioned supply disruptions. Before the war, these supply disruptions were there. You saw, or you see on the left, because of these supply disruptions, global trade has been, in fact, growing, but growing at a much slower pace than what we saw last year. We already see shipping cost picking up. You see that in the middle panel, whichever basically indicator you look at here, this Baltic dry exchange indicator, and in the Black Sea, you look at the shipping costs associated with grains. They have been already increasing. I mentioned the certain metals these countries are producing. Take palladium and platinum. These are used in many industries, and of course the supply of these types of metals will be disrupted in some cases because of the sanctions. These are imported inputs when it comes to catalytic converters, semiconductor industry. In some cases, inventories are already tight when you think about these industries. So supply disruptions, which will further add the inflationary pressures. Let me quickly talk about the longer term growth prospects. Prior to the pandemic, we thought that we will see weaker growth. After the pandemic, our view was that even weaker growth we are going to see, because during the past decade, all fundamental drivers of growth, investment, productivity growth, improvements in education and health, working age population growth, all of them had slowed. So basically potential growth over the period 2010-19 at the global level was around 2.7%. We expected that potential growth to go down to 2.2% over the next decade, this 2020-29. For emerging market developing economies, the growth was around 5% prior to pandemic. We are now expecting that growth to be around 3.7% during the next decade. Of course, the Europe and Central Asia region, where the war is taking place, we were expecting weaker growth already for the entire decade, and in all likelihood, the growth is going to be even weaker because of the war. Let me briefly talk about policy priorities and conclude my presentation. So prior to the pandemic, we were focusing on really, prior to the war, we were focusing really on the pandemic and making sure that there is macroeconomic stability. With the war and with the pandemic, now the big issue is to make sure these short-term stabilization policies in place and working effectively. Their calibration of these policies important, credibility of these policies important, and of course, when it comes to broader growth agenda, and given the multiple risks we discussed, enhancing preparation for a possible crisis and improving overall growth prospects going to be critical. In a nutshell, on the one hand, countries need to pay attention to the short-term risks and be agile, but at the same time, they need to invest in medium to long-term growth prospects by undertaking supply-side interventions and the broader structural policies. In the report, we analyze these commodity cycles. I want to mention this given the South Africa as a commodity exporting economy. A number of countries heavily rely on commodities for their export earnings. And we went through a truly extraordinary commodity cycle before the war. Now that cycle has been amplified. During the early stages of pandemic, of course, the commodity prices collapsed, especially energy prices, as you see in the middle panel, with the kind of the rapid rebound and in some cases, the shortage of commodities. we saw a sharp increase in prices. With the war, those, of course, price increases went even further. When you look at these commodity cycles, one important observation is that amplitude of booms tend to be much larger than amplitude of slumps, even though duration of these cyclical phases tend to be quite similar. So countries really need to take advantage of these booms and use the windfall revenues in an intelligent way and get ready for basically slowdowns and recessions. And that's going to be kind of the critical when you think about the current increase in commodity prices. In the context of fiscal policy, because of the pandemic, sustainability challenges have become more pronounced, as in 2020, a number of countries put basically significant fiscal expansionary measures. They have been now withdrawing these measures, but still government debt, private debt, domestic debt, they all have increased at highest levels. So prior to the pandemic, we were going through the kind of the wave of debt, and now we are thinking that that wave of debt turned into a tsunami. And in all likelihood, we will see a higher debt in an environment of weak growth prospects and very large investment needs. Of course, fiscal policy is being withdrawn, and this has significant implications for growth prospects. So what countries need to do, they need to basically find ways to generate revenues. So the revenue mobilization is critical, and increase the efficiency of spending. In the context of monetary policy, I mentioned the increase in inflation in emerging market developing economies. Many of these countries, in fact, more than 50% of inflation targeting emerging markets have been increasing policy rates already, as you see on the left. So the interest rates in these economies are now much higher than actually what we saw prior to the pandemic. In advanced economies, the response to the inflation has been so far measured. However, as we saw last week, US Federal Reserve increased the interest rate 25 basis points and signaled 6 more interest rate increases in this year and at least 3 more next year. There's a possibility that the US Fed, as well as the European Central Bank, might end up being even more aggressive than what markets are predicting now. So for emerging market developing economies, it's a double whammy. They have to basically deal with domestic inflation, but they have to also worry about global inflation and how that global inflation would affect monetary policies of major central banks. The problem is that this friendly, accommodative external environment emerging developing economies enjoyed over the past decade is coming to an end, with the implication that borrowing costs are going to be higher, with the implication that it's going to be much more difficult to roll over their debt obligations. That means, of course, is getting ready to this new environment by undertaking the necessary financial policy measures, macroprudential measures, and the monitoring measures. We talk about the significant risks associated with food insecurity. Share of food in consumption around 40% in emerging market developing economies. If you focus on low-income countries, it's close to 60%. So how basically policymakers approach the food insecurity problem? The last time we had a major food crisis was in 2010-11. And some countries undertook active policies by banning food exports, by introducing all types of taxes, and of course, by trying to, in a sense, introducing price controls. These types of policies always and everywhere backfire and translate into even higher prices. What is important is to try to basically provide the direct income interventions and use the social safety net to help people rather than trying to basically control prices. We already have a very serious food insecurity problem in the world. As you see in the right panel, there are some African economies, they have this insecurity problem, but in a number of low-income countries, fragile states, we see this challenge. We have been working on this problem for a while. Of course, the problem is even more pronounced now. Let me conclude. I asked 3 questions. What are near-term prospects for the global economy? Prior to the war, there was a pronounced global slowdown. That slowdown is going to be even deeper, and the recovery, in all likelihood, will remain incomplete in emerging developing economies. What are the main risks confronting emerging developing economies? The risks really multiplied. There are serious short-term risks, there are very serious medium-term risks, and there are some long-term risks we should worry because they will have significant implications about our capacity to grow. And finally, what are the policy priorities for emerging developing economies? It's going to be critical to think about the stabilization policies while making sure structural interventions are there. I would like to invite all of you to visit our webpage and check our publications. We have already written quite a bit on the impact of the war, produce a number of course, blogs, and we will do so. Next month, we will release our first study on this issue, the impact of the war on the global economy. We will also release our regional outlooks. Let me stop there. Uma, back to you. Thank you.
Thank you, Ayhan. That was sobering, to put it mildly, but appreciate the informative and insightful presentation. I would now like to invite Wolfgang to please come and present his comments on the presentation, as well as any additional insights on the South African context. Over to you, Wolfgang.
Thank you so much, Uma, Ayhan, Marie-Francoise, the whole Wits team. Yeah, let me just make 4 points and then also give a first reflection on Cora's point that she made in the chat. As you said, Uma, this was very sobering. It's a bit, I'm not sure if it's good news, but the only good news for South Africa, it doesn't look as bad for South Africa than for the world. The short term doesn't look as bad, but for South Africa, the long term was the problem, and that itself is obviously sobering. But yeah, in that sense, that there's a few things where South Africa is not as affected as the rest of the world, but I'll get to this. So first, as a reminder of where we saw the economy pre-Ukraine war, basically South Africa experienced a sharp contraction in 2020. It only experienced a moderate rebound, 4.5% rebound 2021. And this year we project still roughly 2% growth, which, as we know, with a 1% population growth is very mild. But in short, that means that basically by the end of this year, then South Africa is where it was the economy in 2019. So 2022 is where it was 2019. And for the world economy, it recovered on balance a year earlier, as you saw from Ayhan's charts, because 2021 was a very strong recovery year for the global economy, and Asia drove a lot of this. But you all know and remember that 2019 was not a fantastic year for South Africa, because it was about where South Africa was in 2010 after the World Cup or after the global financial crisis. So broadly, if South Africa has another 1 or 2 weak years, then it would have lost 15 years. And that is, I think, the big challenge, with or without the global context that you just saw. And that's why some of this more fundamental question of how we can revive South Africa's potential and long-term growth potential in an environment where there's still a broadly positive demographic momentum, where Africa could still ride a potential wave, where Asia and investment come. That is, I think, the fundamental question that has not changed with the war. So let me mention 3 things linked to the crisis in Ukraine, and then one brief thought on environmental aspects and climate aspects, building on Cora's question. So for number one, South Africa has hardly any trade relations with Russia or Ukraine. It's actually around 0.5% is the total trade. So it's 0.3% of exports and 0.8% of imports. There's some grain imports that South Africa has from Russia and Ukraine. So in that sense, South Africa is less affected than other parts of the world by the crisis that directly affected. However, there's indirect effects, and there is some which are positive, and Marie-Francoise spoke to them, and some are more concerning. The positive is that higher commodity prices are good for South Africa, even though high oil prices are not good, and that add, another percentage also point on the import bill. The current one, gold, iron, platinum, iron ore, coal exports, which represent a quarter of total exports, have been rising as well, and that's positive for South Africa's I emphasize macroeconomy, because I'll go into the more micro aspects in a minute. So in that sense, South Africa, which has traditionally been a current account deficit country, is now been since COVID been a current account surplus country, and has also the fiscal position that we were very concerned about 2 years ago, has now been stabilizing at a still too high level, or higher than it was before, but it's been stabilizing. So you could also argue that in this setup now, South Africa is almost like in a stable stagnation situation if it would continue like this. But it's still a problematic stagnation, because one thing we will not have much time to talk today, but it's still fundamental, is that whatever was there in terms of recovery for South Africa last year, it was a jobless recovery. And the more you have, it's all good that the mining sector does well in South Africa, but it's not very labor intensive. It's very capital intensive. And by contrast, and that's the downside of the emerging global crisis that Ayhan presented now, the sectors that are more labor intensive, say tourism, manufacturing, may be hurt by the global slowdown, because there'll be, among others, less tourists from Europe and from the US. There'll be less demand for some manufacturing products if the global economy in South Africa's key trading partners, including the US, Europe, and Asia, will slow down. And that, again, is a final point to reinforce one of Ayhan's points, where then the inequality story comes in strongly, where we launched just a major report last week about inequality in the whole sub-region, where South Africa, again, and its neighbors stand out, where because of this jobless recovery, and South Africa lost more than 2 million jobs at the peak of COVID and has not recovered, less than half of that. So it's still substantially net negative compared to 2019 in terms of jobs, will further then risk to add to inequality. Final brief point on Cora's question, on the question, can this expected reduction in production also lead to less environmental pressure? Again, I think this would vary the whole webinar, but here I think, and I was just on a bigger call with German policy actors, given the climate challenge. And they obviously, in the short term, there's a risk that there'll be more pollution or more emissions, because if you move away from Russian gas, one of the few options is only coal, possibly nuclear, but also then, gas from elsewhere. And so I think the short-term energy balance, at least, risks of being not positive. There could be a medium-term possibility, because there will be as much scale up also in renewables. And obviously, as you indicate, right, if there's less growth elsewhere, there's also then less consumption or energy generation. So there could still be a net negative, but I wouldn't bet on a major positive environmental or climate impact because of that shift away that could partially be to more so to say even less clean energy than gas from Russia. So with this, back to you, Uma.
Thank you, Wolfgang, and thanks for highlighting the very thin silver streaks, at least for South Africa. Would you like to respond now, Ayhan, to the comments before I hand over to the other discussants?
Thank you, Uma. Maybe it's better to have all discussants, and then we can get more questions, and I can respond all of them at the same time. Thank you.
Perfect. So Kenneth, now over to you.
Thank you, Uma, and thank you very much to the team from the World Bank group for the presentation and for giving us this opportunity to just give some of our brief thoughts on the report. Just want to see if I can share my screen just to help me to look at that. Can you see my screen?
Yes, Kenneth.
Yes, okay. So thank you. So yes, I would just like to give some brief reflections on the report. And maybe it'll be some things that you can respond to if you agree with them or if you think there's other ways of seeing it. So just in brief summary, reading the report, I think it identified 3 major challenges, and we've heard some of that from the speakers so far. The one is dealing with record levels of debt in the wake of the COVID pandemic, the large fiscal response, rising levels of income inequality within and across countries in the wake of the COVID pandemic. And then the report, which was published before the outbreak of a war in the Ukraine, spoke about rising levels of uncertainty. And it spoke there about COVID variants, in particular, climate change, energy insecurity and food insecurity, as well as supply chain disruptions. So I suppose a fortiori, even more now, there's rising risk of uncertainty in the world. We're building uncertainty upon uncertainty, if we think about what has been happening. The report then says there's an agenda to address those challenges. The one is to deal with the debt, the one is to deal with the inequality, and the one is to deal with the rising uncertainty. So in dealing with the debt, it spoke about, and the speakers haven't mentioned this, mobilizing finance and assistance with debt relief for the world's poorest countries, who are now facing $35 billion in debt service payments, according to the report, in this year. So maybe you can just tell us more about that, because it seems pretty important to me. Dealing with inequality, reforms to promote productivity, trade and investment, as well as digital services, and to quote the report, access to continuous electricity supply in developing countries. So fundamental to that potential growth story, or the long-term growth story that Wolfgang mentioned, in South Africa, but throughout the world, really the way to address inequality is through raising potential growth levels and the quality of that growth, including access to digital services, which won't work if you don't have access to electricity. So it's quite an interesting insight. And then dealing with rising uncertainty, I'd say the Global Economic Prospects report doesn't really provide any ready solutions to rising uncertainty in the world. It's just and supply chain disruption. It highlights it as a risk, but it's hard to see how it can be dealt with merely by economic policy. So in reflecting on those, there's just 3 points I want to reflect on. One is about the reduced fiscal space and rising public debt. The other one is the lower investment levels, and the other one is energy transition and commodity prices. I'm really just taking it back to a South African discussion, some of those points. So as we've seen, there has been reduced fiscal space and rising public debt. You can see from this diagram taken from the report that the emerging countries, the world, advanced countries have all seen, as a percentage of GDP, quite significant rises since 2010, since the previous crisis, really. There's just been continuous rising economic debt, and the acceleration of that increased rate of economic debt growth since the COVID pandemic. So the world is precariously sitting on a larger and larger debt mountain, as it were, which is something that is a stylized fact of the global economy. So obviously, due to the COVID pandemic, that very last tail here, where we see it really accelerating, tax revenues were subdued during that crisis, and support measures were required to increase support and spending. Usually, a lot of that was non-permanent commitments to get through the crisis. There's new spending pressures, spending on energy transition, climate adaptation, and security and defense will be new spending pressures. And the GEP report suggests that to deal with this, requires a careful review and prioritization of public spending, subsidies, and measures to expand the tax base, and reprofiling of debt to spread out repayments and reduce exchange rate risk. So that's identifying the problem of the rising debt, and then certain prescriptions as to how to deal with it. just reflecting on some of that in the South African context, I was fascinated by Wolfgang's characterization as stable stagnation. So it sounds quite good to have stability, but stable stagnation, I think, is a very clever way of explaining our predicament. With regard to the fiscal space, South Africa's priorities have been to contain the trajectory of the rising national debt. And I think to some extent we have begun to turn that corner. So we had a national debt of about 25% of GDP before the financial crisis of 2008. And now it's 85% or 75%, but it isn't rising at that rate. It's become a national priority to curb the rate of increase. Better management of Eskom debt. So within that, the Eskom debt is a very large component of that debt problem of South Africa. 400 billion of the 3 trillion or 4 trillion is Eskom's value. And there also needs to be a full interrogation of proposals regarding increased social spending and how it can be financed, whether from borrowing or from taxation. And there are risks that we will further reduce the size of our tax base. So this is a big debate in the South African economy at the moment regarding whether some of the COVID social support measures can be made permanent. And if so, how would they be financed? And if they are financed by taxation, there's a risk of the tax base shrinking. If by borrowing, it contradicts the objective of bringing that fiscal space under control. So it's a very interesting point seen in the global context of your report. And the other issue in South Africa regarding finance and debt is a just transition offer that has been made to the country during the COP meeting, whereby if there is a commitment to decarbonization, we will, as a country, be able to access concessional finance to assist with that just transition. But in the context of a shortage of electricity and load shedding, that decision becomes very difficult, because how do you begin to decommission power stations that are extremely old and very inefficient and are breaking down as a quid pro quo for that concessional finance when you have a shortage of electricity? It sounds a bit like the German problem. Do you have the Russian gas is not coming into the country? Do you resurrect nuclear? Do you burn the old coal fires? It makes it more difficult when there's an electricity shortage to undertake that transition. So just two more points on this. So that was the fiscal space and finance point. The lower investment levels, I think, as the previous speakers have said, investment is beginning, or before the war at least, was projected to return to normal levels for the advanced countries. But for us in the orange here, in the emerging countries, we have a scar that has come through, and investment levels are not projected to return. And will remain markedly below pre-COVID levels owing to a number of things: lower vaccination rates, the tightening of fiscal and monetary policies, and that persistent scarring. Reflecting on these points on the South African perspective, we have our investment at historic low levels, currently around 15% of our GDP, whereas we were close to the 25 peak, during the post-apartheid era, in the late 1990s and early 2000s. Also, the commodity cycle helped us to lift that investment, which was a super cycle at that time in the early 2000s. And now we're way below that. And so again, in the global context, we see that is something that's happening to many developing countries, that we cannot get investment levels back to where they need to be. And in South Africa, it's leading to particular issues like decay in infrastructure, made worse by the fact that public sector capabilities regarding project management are reduced, and infrastructure budgets are being squeezed out. So it's about the quality of that spend. What are we spending on? It's rising wages, rising social spending, rising debt service payments begin to squeeze out so much of that investment recovery. So there's a link between the fiscal space and the investment recovery. And there's talk, can we get a social compact, government, business, labor parties to work together on lifting that investment rate? What would be the trade-offs? What would be the commitments with reform from the government sector? I know Marie-Francoise, myself, others spoke a lot about the 100 megawatt electricity reform, which took place in South Africa, very successful discussions that we had. but how do we get those kind of reforms, the auctioning of spectrum, to try and lift the investment rate again, supply side reforms? I think Wolfgang was talking about that. What's happening in terms of the longer term growth in the country? And then in the energy transition and commodity prices, the GEP report argues that the energy transition away from fossil fuels could tend to amplify commodity prices. So it's a fascinating and technically very useful part of the report for our students and ourselves to read. The commodity cycle research that you've added to the literature, I think, in that report. It's really fascinating, and it's a congratulations to the team who worked on this part. And the link between the commodity prices and the energy transition was really well made, and I found that very useful. You can see from this diagram here that commodity prices were 2020, 21, they have been rising. The metals in the red were rising, and South Africa has been benefiting from some of that, helped us to stabilize our national debt. Agriculture has been rising, energy has been rising, but you can imagine the impact of the war, as we've been hearing, is going to push this even further. So from the South African perspective, we will need to accelerate our energy transition by accelerating investment in renewable energy. That's our major priority. And we must promote upstream and solar panels and wind investment and technology in our industrial policy. And also downstream sectors become viable if you have renewable energy like green hydrogen, electric vehicles. So the key thing is, in the context of an electricity shortage, we need to see massive investment in renewable energy capacity to unlock both those upstream and downstream possibilities. There's pressure on government to tweak the fuel price formula. I mean, whether you're Joe Biden or Cyril Ramaphosa, everybody's under pressure now with the fuel price. You know, what are we going to do with the fuel price? Because it's politically a hot potato. So there is talk about maybe some tweaking of our formula. But at the very same moment, South Africa's refineries are shutting shop or closing shop, and had decided to before the war. So on the fuel side, there's some pressure on government to say, well, you must take over the refineries because it'll be better if we still do refining rather than importing the final product. Whereas the large oil companies are saying, we just want to convert our refineries into storage facilities and and it's a very interesting, as we pivot towards renewable energy, electric vehicles, to be investing in something like refinery capacity, state-owned, could be a major policy error. But you can imagine when the fuel prices are rising, that's the time when prices are out of kilter, that's the time when policy errors can be made. And it's something that needs to be taken quite importantly. And then finally, as a commodity exporter, South Africa needs to accelerate our exploration for energy metals, because in the energy transition, the types of metals that will be useful, whether it's copper and platinum and vanadium and manganese, the types of metals will move away from coal and oil and gas over the longer run towards other metals. And the region, South Africa, Zambia, Congo, all of the region has got these metals, you know, and should be looking into, we're not exploring like we used to for the new, our exploration spend has decreased extremely, you know, it's fallen through. So again, it's a long-term growth problem, as has been suggested. So in conclusion, I just want to say your report is fantastic and really highlights important issues for all of us. And it's for the world and for South Africa. I just want to congratulate the World Bank researchers for the quality and the relevance of the work. Unfortunately, I can criticize you for not seeing around the corner and telling us about the war, but that's not a fair criticism. But it was relevant then, and it continues to be relevant now, but we need another report. Thank you very much.
Thank you, Kenneth, for driving home the South African perspective strongly, and also for flagging the interesting parts of the GEP report, especially the one on commodity prices and energy transition. I'm sure that will motivate the audience to take a look at the report. Moving on now to the third discussant of this afternoon, let me call upon Ismail to please take over.
You are muted, Ismail.
Ismail, we cannot hear you.
Can you unmute? Can you unmute Ismail?
Your camera is now on.
Hello.
Thank you. We can hear you now.
Okay, thank you, Ma, and thank you for the presentation, Ayhan. And I really appreciate the idea of you bringing in the issue of the Russian war to the whole analysis. Of course, it wasn't part of the report, but it was very nice. And I'm actually going to start from how to resolve the high debt after the pandemic. Looking at the peculiar nature and characteristics of the sub-Saharan African economies, we know that debt is actually one of our major issues. And you know that the rise in debt has actually led to several countries initiating debt restructurings. And my focus is now on those debt restructurings. We know before the present one, the G20 framework, we have several debt facilities. The several ones before the G20 framework. And you know that the G20 framework at present, you know, the framework does not have a clear methodology to actually assess the comparability of this treatment. Now, looking at the earlier ones, the earlier debt facilities we have around, the multilateral debt initiative, okay, and the Brady initiative, and so on like that. And there is no clear-cut difference among all these debt facilities and the present G20 framework. And if you look at that G20 framework, it focuses on debt relief via maturity extensions and interest rate deductions. Now, my question is, what actually determines these interest rate deductions? Because interest rate deductions have been part of what most sub-Saharan African countries have been claiming for. That, okay, what we actually pay, the interest we pay on loan is actually more than what we are owing. Now, this G20 framework focuses more on interest rate deductions, and who determines this? At what rate? And the most shocking part of it is that if you look at the report of the G20 framework on debt initiative, the middle income countries were not considered. And I begin to ask, why were they sidelined? Why were they not considered? Are there any conditions that should be fulfilled for them to be considered as part of countries that will benefit from this debt relief? And from those debt framework, because you know that debt is very, very important from the perspective of the sub-Saharan African economies. If you don't get our debt right, there is no way our output is going to increase. It is just like we are retrogressing. Our debt must actually be at a particular level for other macroeconomic fundamentals to work well. Without we getting our debt right, it means that our macroeconomic fundamentals will not actually perform as we expect them to perform. Now, at what point are the commonalities among the past facilities I've mentioned earlier? Those past facilities, at what point are they different from this G20 you actually proposed? Because what you have proposed with the G20 is a fantastic idea. But for this G20 idea to work for middle income countries, at what point? And the countries included in the framework, why were they included at the expense of other countries not involved in the framework? Now, if I now narrow it down to South Africa, because Kenneth has actually mentioned, there's no way we are going to talk about debt. We are not going to consider the role of tax base. And the tax base is equally important. Looking at what has happened between 2020, 2021, and presently 2022, you will see that there is actually no way where we can reduce the level of debt in South Africa, considering it is around 75% or more to GDP ratio. And looking at that alone, and with that G20 framework, how do you think South Africa will actually going to benefit from it? And more interestingly, South Africa is part of the G20. It's part of this G20, and I continue to ask the question, the 75% as a percent of GDP, and the idea in South Africa, with these conditions, South Africa as an economy benefits from this debt restructuring initiative. And another particular aspect that is very interesting, and I really have to appreciate the team for that presentation on commodity price cycles. Very, very interesting and well detailed. And at this point, I think it is something we can share with our postgraduate students on various sets of research issues or concerns or research questions they can actually answer, because a lot of research questions from that particular aspect of the report that I think it can actually benefit postgraduate students. Now, from that, Kenneth mentioned COP26, and we know that South Africa is also a net commodity exporting country. And with this commodity boom, South Africa is also benefiting, just like most sub-Saharan Africa countries that are commodity exporters. Now, we are interested in moving from fossil fuel to and if I am to take you back to the COP26 and the UN Change Conference that was held in Glasgow. And you know that the leaders of South Africa, United Kingdom, United States, France, and Germany, and the European Union actually announced a kind of a groundbreaking partnership to support South Africa. And we know that South Africa is actually the world's most carbon-intensive electricity producer. And they plan to support them with around $8.5 billion, if I'm not mistaken, over the next 3 to 5 years. And the whole idea of supporting them is to transit from fossil fuel to renewable energy. Now, this transition now from coal to low carbon economy, and we know that the first year is almost gone. And if these funds, if this money comes in, it is actually something going to assist the South African economy in trying to reshape the economy from fossil fuel to low carbon economy. But up to now, I don't know, and I've tried to check the report very well, because we know that transiting from a low carbon, from fossil fuel to renewable economy, looking at the present issues we have around the globe of COVID, pandemic, the present Russia war, you will see that it sounds maybe years to achieve transition from fossil fuel to low carbon economy, and looking at high debt that is within the South African economy. Now, at the level of World Bank, we know that the agenda is to assist developing economies to move from fossil fuel to renewable energy. But what exactly are the parameters that is actually set in place to assist these economies in transitioning from coal to low carbon economy? And I must agree with you that South Africa is benefiting from commodity boom. But the question I ask myself is that this commodity boom is a windfall, like you mentioned, and South Africa must try to leverage on this windfall for the short period of time. However, we have to understand the fact that this commodity boom comes with its own inflation rate, adjusted inflation that is related to commodity prices. And in modeling inflation, it means that the South African economy will have to account for these changes we are talking about, which I think your suggestion about they should actually leverage on this commodity boom, we should also consider the effect on other macroeconomic fundamentals, which in turn affects another South Africa in the economy. And I believe that, of course, it is important that South Africa have to move away to renewable energy, but the question is how and in what form? And at what point do you think is always the best way for the economy to move to the renewable energy? Looking at the present predicament, the whole world is at now. And we know that we have to think of exploring energy metals. But don't forget, energy metals is controlled by Russia. And Russia has the largest deposits of some of these metals, like you have mentioned, and they dictate what happens in the commodity market as regarding these energy metals. Now, at what point do you think that the output of emerging market economies will not tilt towards what is happening in the Russian war? Looking at the fact that what you presented to us and what is in the report is that advanced economy is almost moving closer, achieving their growth pattern, the growth level. But emerging economies, we are still far away from that particular line before the war. And there is war now, which means we are actually going to be further from that particular point, from that particular growth level. And I believe that with the present issues around the world and the present conditions concerning what is happening in Russia and Ukraine, it means that the global output we have read, we have presented, no doubt is going to fall. And for emerging market economies, it's going to fall. It means that the growth trajectories, we have to be reshaped for all the countries we are actually talking about. Now, thank you very much for that wonderful report and presentation. And I need to thank the team because it's actually an interesting report. And I hope we can learn one or two things from it. And I believe that the School of Economics can also benefit from it, and our students at large can maximize their potentials from this report. Thank you very much.
Thank you, Ismail, for those additional food for thought and flagging the issues, especially around debt and just transition of energy in South Africa. So at this point, I would like to hand over to Ayhan for his response to the comments made by the three discussants. Ayhan, your thoughts in response, please.
Thank you, Uma. Let me thank Wolfgang and really thank Kenneth and Ismail. Obviously, they studied the report. I think the beauty of presenting this report at the university, colleagues immediately see the value of report as a pedagogical tool. Let me first talk a little bit about that pedagogical tool, because I strongly urge colleagues to use the report and tell graduate students to look at the report. This analytical chapters we write, we put actually a lot of resources into these analytical chapters. We think that they reflect cutting edge literature, cutting edge econometric techniques, and of course the best data available. All the figures are available on the web. We make the data sets available. For undergraduate students, there is wealth of information because we also write summaries of these reports, the main messages, so one can use these reports in undergraduate classes, especially intermediate macro classes, development classes you teach. but it's a wealth of information, especially for graduate students. Kenneth and Ismail mentioned, we are very proud of commodity chapter. We are very proud of the inequality chapter. Of course, the debt piece as well. Let me briefly discuss some of these issues you raised. You both mentioned the debt challenge. So in the report, we have, of course, this observation. In general, debt in emerging market developing economies reached highest level over a long time period. Prior to the pandemic, in fact, December 2019, we released a book called Global Waves of Debt. The idea was that there is this wave of debt that started in 2010, and that wave could trigger, if financial conditions get tighter, a global recession and a multiple financial crisis. As I said, we released that study in 2019 December. Of course, 3 months after that, a global recession started, not because of a debt crisis, but because of the pandemic. What pandemic did, it made this debt problem even worse, in the sense that the debt stock has risen significantly over the past 2.5 years. Now, the report talks about dealing with debt challenges, especially in low-income emerging developing economies. We have an analytical piece comparing the current debt relief initiative by the G20. This is very important. This is a G20 initiative, and it's called Common Framework. We compare the Common Framework with previous debt relief initiatives the global community undertook, like the Brady Plan, the Baker Plan, the MDRI, all of these the debt relief initiatives we have seen over the past 40 years. Now, what we learn from these debt relief initiatives when we compare them with the Common Framework, the first observation is that Common Framework in many dimensions are similar to these previous debt relief initiatives, and many of them unfortunately failed. The idea was to basically provide the interest rate reductions, just a little bit of the push to debt, extend the maturity, and that came with certain, of course, the provisions. Countries have to meet certain macro financial targets, undertake certain policy interventions. Now the Common Framework managed by these creditor committees and the Paris Club have certain shortcomings, similar to shortcomings we saw in these earlier debt relief initiatives. Ismail mentioned some of these initiatives. For example, hoping that if you adjust the kind of the debt, if you don't necessarily structure in a way that translates into an outright debt reduction, but reprofile the debt, you are not necessarily reducing the pain associated with that. In fact, you might be pushing the can down the road. So the other important issue, Ismail mentioned this comparability of treatment, how you are going to treat different creditors. We think that that is something also that needs to be improved, and it's going to be critical to bring the private sector into the process, and in some cases they need to play an important role. Now, the Common Framework is relevant for what we call the SSI eligible countries. Those countries, they could basically utilize the debt service suspension initiative, and those are low-income countries or lower middle-income economies. Truly middle-income countries, we don't have, for those countries, as Ismail noted, there is no initiative to overcome the debt problems. They still need to think about how, if there is a debt stress situation arises, how they are going to address that stress situation. The truth is that prior to the war in Ukraine, this was a kind of a #1 topic on our agenda going into the spring meetings. We still, in fact, we wrote a paper for the World Bank IMF Development Committee on this issue and how to overcome the debt problems and how IMF and the World Bank have been playing a role to address these debt challenges. We will still do that. We will discuss, of course, this issue at the Development Committee and express many of the issues we raised in this study, including the need to improve common framework to address debt challenges, the need to find a kind of a clear framework if we have problems in middle-income countries, but more importantly, the need to provide debt relief. And that starts with actually the not just restructuring the debt, but in some cases, reducing the stock of debt. All of these things we are going to discuss at the spring meetings, and you will see our new study. Kenneth talked about this raising potential growth. Kenneth, this is something we have done extensive work earlier, and I showed some results here. In earlier Global Economic Prospects report, we looked at potential growth using different methodologies. We estimated potential growth, and of course, we have forecast of potential growth, which is something, you know, for an institution like the World Bank, a critical metric. You made an important observation: investment weakness. This weakness has been around for the past decade. As potential growth slowed, investment remained sluggish. And there are multiple reasons for that. Despite the kind of the very friendly external environment, countries did not necessarily borrow to invest. They borrow just to close the holes in their budgets. So we are worried about the debt accumulation, because that accumulation can be fine if that accumulation translates into, of course, the higher growth returns, some investment projects with those growth returns. We think that this sluggish investment is a big problem when it comes to convergence issue, which is something Ismail mentioned. Ismail's point was that now the convergence of these emerging developing economies to advanced economies will be even slower after the war. Of course, when you have weak investment, that convergence potential is further constrained. Energy transition is something we are working on, and how to finance energy needs, especially climate-related challenges, are on our agenda. In the context of energy transition, I agree what both Kenneth said and Ismail said. There are significant challenges, but there are also significant opportunities for countries like South Africa, given that there will be significant demand for certain types of metals for the renewable energy production, and those countries, they are able to produce those metals, are going to have windfall gains. Now, the thinking about the broader issue of development, I think when we think about the history of emerging developing economies after 1990, there was a period of, in a sense, opening There was a period of significant reforms in terms of improving macroeconomic frameworks. And early 2000s, we saw an increase in growth, the highest growth since 1970s emerging market developed economies delivered. The commodity cycle played an important role. And of course, after the global financial crisis, there was a significant slowdown. And that slowdown came along with the slowdown in advanced economies. Going forward, finding ways to improve productivity growth, finding ways to improve potential growth, finding ways to improve, of course, investment growth, going to be critical. Now, Kenneth mentioned how we are going to do all of these when we have these constrained fiscal balances, and there our messages are critical, and it is high time for policymakers to think about how they approach fiscal policy. And it's not just cyclical fiscal policy, it's about undertaking the structural measures and being aggressive when it comes to taking care of the challenges associated with the weak performance on the kind of the books of these sovereigns. Those could be state-owned enterprises. Those could be related to the spending of the government, not efficient, and of course, finding ways to expanding the revenue base. At the end of the day, the books have to adapt. When they don't adapt for an extended period of time, there are consequences of that. We are coming to a point, I think we will see higher interest rates. It is going to be difficult for countries with current account deficits, limited reserves, and of course, already suffering from a slowdown to cope with the tightening cycle in advanced economies. I think all of these are well known, and some of these things will be discussed in the coming spring meetings. In the context of the war, there are significant implications when we think about the energy and food space, and of course trade. There were some questions in the Q&A on these issues. Now, our hope is that there will be a huge push to accelerate energy transition and the use of renewable resources for energy production. This is much easier said than done. It requires a lot of will, and in some cases, it comes with pain. But I think once again, what the global community learned, relying on the fossil fuel-based energy resources, whatever the sources of those resources are, has consequences. And those consequences are related to, of course, the climate, but more importantly, in some cases, especially in this case, related to energy, related to security, and how the global community is going to basically walk through this tightrope, thinking about the security issues, thinking about the issues related to climate change, is something we will have a discussion on during the spring meetings. Now, in the context of trade policy and supply side disruptions, governments need to be ready. The consequences of these disruptions, those consequences will manifest themselves, of course, the energy security and the food security in the first place. But at the same time, when we think about these inflationary pressures, there will be additional inflationary pressures as commodity prices, skyrocket, and we see supply disruptions in many parts of the world. Now, of course, the Europe, Central Asia region will join that, group of regions that suffer from supply side disruptions. Could there be certain opportunities? Yes, there are certain opportunities. Trade policy could be the policy to think about, to take advantage of those opportunities. It's going to depend on the basically comparative advantages of the countries, what types of products they can incentivize, and what types of policy approaches that they can utilize to take advantage of the crisis. The issue of risks in the near term, as I mentioned, it's not just the number of risks increasing, it is just basically the reinforcing each other. And in that environment, policymakers need to be extremely cautious, calibrate their policies, make sure these policies are credible, and make sure that they are well communicated. I think we know that when external conditions are friendly, there are many things governments do. They might not be necessarily the right things to do, but they can keep them under the carpet because it's very easy to borrow. When global financing conditions are not friendly, things change rather quickly. The financing constraints become binding, and of course that generate financial stress episodes. When you look at the global tightening cycles, many of these cycles were associated with financial stress in emerging developing economies, especially if there is a significant reversal of policy, and that policy was pushed aggressively. And what we are seeing right now, when you think about the monetary policy expectations 6 months ago, and when you think about expectations today, there is a significant change how basically central banks are approaching their policies in advanced economies. And of course, that could have material consequences for emerging market economies. Let me thank again the Wolfgang, Kenneth, and Ismail. And I'm hoping that I will visit Wits University and exchange views with you and with your students sooner than later. With that, let me turn to Uma.
Thank you, Ayhan, for comprehensively covering some of the issues and comments made by the discussants. You've also responded to the 2 questions raised in the Q&A, so I'm not going to separately post them to you. From the School of Economics and Finance, I would like to say we are awaiting your visit. It would be a privilege and pleasure to host you. To wind up today's discussions, I would now like to invite Professor Tendai Kwetitso, who is an associate professor in the School of Economics and Finance, to wrap up today's proceedings. Over to you, Tendai.
Thanks, Uma. I hope you can hear me. All right.
Yes, please proceed. Thank you.
All right. Thanks, Uma. And I think my job is quite simple. I just want to thank Ayhan for a very comprehensive presentation on the global outlook. I think it's a huge report, and he did quite a good job of trying to get us the main points that are really emanating from the report. Like Ismail, I appreciate the fact that you've gone further and actually also included the global risks emanating from the Russian-Ukrainian war. I think you raised quite a number of interesting insights, including, for example, the fact that the recovery from COVID pandemic is quite slow, particularly for sub-Saharan Africa, for example, and also the fact that the pandemic pushed poverty levels up, understandable given that the poor are less able to deal with some of these shocks. You also mentioned that even inequality also went up. And of course, like I've already mentioned, that the recovery from COVID is really being compounded by the invasion of Ukraine by Russia, right? Something that is making the world or global uncertainty really to increase, affecting macroeconomic stability, and I think making it quite difficult for policymakers really to respond to all these challenges. The need for really macro stabilization that really responds to all these different challenges. The question is, would one say the usual macro, the usual monetary policy and fiscal policy, are they really sufficient to deal with these kinds of challenges that we are beginning to face now? I mean, you mentioned the issue around debt sustainability. If you look at a number of African countries, they were already facing challenges when it comes to high debt levels, and sometimes even failing to honor some of their debt obligations. So COVID pandemic came in, compounding the problem of debt sustainability for these countries. And now we are talking again about the Russian war and its implications even on some of these economies. They are not immune, even though this is a conflict that's happening far away from them. So I think I wouldn't want to continue repeating what has been raised by my colleagues. I would want to mention that I think this is a very important report. We look forward to you coming to Wits to perhaps discuss some of these issues further. As has already been mentioned by colleagues, yes, we do find this report very useful with very important insights. Our undergraduate and postgraduate students, I'm sure will find it also very, very useful. Very important and interesting research ideas can actually be gleaned from this. Let me therefore take this opportunity once again to thank you, Ayhan, to thank Wolfgang as well, to thank Dr. Marie-Nelly, the World Bank Country Director for South Africa, Botswana, Namibia, Lesotho, and Eswatini. Also to thank my colleagues, Ismail and Kenneth, for raising very interesting issues and insights emanating from the report, and also for focusing on certain aspects on economies that they are very conversant with, South Africa in particular. May I also take this opportunity to thank Uma, the head of school, and Imran, the outgoing dean for the faculty, I think, for organizing these and facilitating the SAF centenary webinar series. Very useful exercise. We are interacting with many presenters, discussing very important issues affecting South Africa and Africa as a continent as well. I would like to basically conclude by also thanking our admin staff from our School of Economics, Mamusa and Tolwana for running around. Also from the World Bank side, I want to thank Zandile Rashtanga. You would think that perhaps organizing an online seminar is easy, but there's a lot of running around that's done by our colleagues in the background. So I just want to thank them as well. Yeah, I think that's my job. Uma, I will hand over to you as the moderator. Thank you.
You are muted.
Sorry about that. So with that, we conclude today's proceedings. Thank you once again for your participation. We look forward to future engagements as well. Thank you very much.
Thank you. Thank you. Bye now. Bye,
Bye.
Kenneth.
Bye-bye.
Nice to meet you.
Thanks.
Nice
You
to
too,
meet you,
Ayhan.
Ismail, Uma,
Tendai.
Tandai.
Bye, Ismail.
Hope to see you. Hope to see you in South Africa. Take care.
Thank you.
We
Yes.
await you.
Thank you.
Thank you.
All right. Bye.
Bye now.